Okay, so in this video, we're going to talk about how to invest in stocks for beginners. So this video is to show you guys how to invest in stocks. Maybe you're new to investing in stocks, or maybe you've always been wondering about investing in stocks, but you're not really sure to get started, or you've heard people talking about it and you've seen it on the news and you've been wondering for a while exactly what are stocks and how the stock market works and things like that. So hopefully this video will clear a lot of things up. So let's get right into it. So here we are on the first slide. So what are stocks? Okay, so stocks represent shares in a real life business. So for example, throughout this video, I'm going to be using Apple as an example because I think it's a very good example for explaining this. Stocks are basically portions of a real life company. So if you own a share of Apple stock, you are a shareholder. Even if you just own one share, you own 10 shares, you own 1,000 shares, you own a percentage of that company. So that gives you a real life ownership in the Apple business. So depending on how well it does, if the Apple does really well and they sell a lot of products and they have a lot of people sign up for their services, you make your investment is worth more money. If Apple does poorly and doesn't do as well, your investment will generally over time lose money. So that's one of the reasons why some of the richest people in the world, the Mark Zuckerbergs, the Jeff Bezos, the people that a lot of times start these companies end up getting so rich because they own millions and millions of shares in that company. So, for example, Mark Zuckerberg owns millions of shares of Facebook. So, as Facebook stock price goes up, he makes more money, guys. So that's really why stocks are so valuable to own. So stocks, they are publicly traded on major stock exchanges. So the two major stock exchanges in the United States are the NASDAQ and the New York Stock Exchange. And there are many stock exchanges around the world as well. You have stock exchanges in Brazil, London, Japan, Korea, uh, France. So many of other countries trade stocks, and you have basically all different types of companies, that's US based companies and international companies, are traded on these stock exchanges. And you also have something called the OTC exchange, which is the over the counter exchange. So these are stocks that are not traded on major exchanges, but are still companies, much smaller companies in the United States. And these companies can be like some of these cannabis stocks that you see coming up, or sometimes it's like an up and coming company that isn't big enough to make the New York Stock Exchange or NASDAQ, but they still want to, allow people to buy and sell shares publicly. So every stock has a ticker symbol. So a ticker symbol is basically, it's like an acronym for people to easily identify the company. So instead of saying like you want to look at Apple stock, you would just simply search for AAPL. So whenever you go to a site like Yahoo Finance, or you go to Morningstar, or whatever, if you guys already have a brokerage account and you type in that symbol, that's going to allow you to quickly search this stock. So whenever you hear someone say something like, oh, I have shares of AAPL, or I have shares of NFLX, that's a ticker symbol for Netflix, just realize that they're talking about a certain company. So it's just a way to kind of represent that company without always saying like Apple stock. We just say AAPL. So now stocks are riskier investments than bonds, high yield savings, or mutual funds. So the reason why stocks are very risky is simply because you as a shareholder, you own a portion of that company, but if the company does really poorly, like they file for bankruptcy, or the company has a scandal or something like that, a lot of times your investment will be worth a lot less money. So that's why they're much riskier. So bonds, guys, those are basically IOUs from the government. As long as the US government doesn't fail, those are much safer. High yield savings accounts, you're not actually investing in anything. The bank is just paying you a much higher interest rate because you have basically an online account. And online accounts are much cheaper to manage than full service savings accounts, so they pay you a higher interest rate. And mutual funds are just a huge collection of stocks. So a lot of times mutual fund managers will buy many stocks like Apple, Google, Amazon, and put all of those companies together, and then have investors pile into mutual funds. So mutual funds are safer, but stocks are much riskier. But because they're riskier, you have the potential for higher gains. So there's two ways to buy stocks. You can buy stocks through a broker, or like a stock trading app like Robinhood or Fidelity or E-Trade, or you can buy them directly using Computershare. So Computershare is a way you can buy stocks directly. If you guys don't prefer using brokers, but I like using brokers because it just makes things much, much easier, and I can trade on the go no matter where I am. So it makes things very easy. So moving on. Okay, so why invest in stocks? Well, the reason why you invest in stocks is stocks generate higher returns than bonds and index funds over the long run. So, on average, the U.S. stock market has generated about a 10% annual return over like the past 100 years, and that's much higher than bonds or index funds. So, if you were to put, say, $1,000 in just a general stock, now obviously it has to be a quality stock, so something like Apple or Google, you get my picture. Over the long run, you're going to have more money than if you would just put that money in bonds or index funds. And some of you guys have experienced this. Maybe if you guys, your parents or your mom or something like that, set up a savings account for you. And maybe when you turned like 16 or 18 or something, you had a bunch of money. But if that money was put in stocks, let's say it was invested in, for example, Netflix stock, you would have a lot more money. So stocks just give you higher returns over the long run. That's why people are attracted to them. So, as a shareholder of stock, you receive voting rights, access to special dividends, and other perks. So, a lot of times, companies will have annual shareholder meetings, and you can actually go to these shareholder meetings and meet your fellow shareholders, talk to the CEO and the board of directors. Warren Buffett is a very, very famous investor, arguably the best investor of all time, and his Berkshire Hathaway shareholder meeting is basically like it's like the Super Bowl for stock market investors. It's like a big festivities, and they have lots of things going on there. So, being a shareholder, it gives you a lot of things, and also you get to vote. A lot of times every year, you'll see proxies sent to you where you can vote on the board of directors, changes in the company, and oftentimes companies will issue special dividends. So, for example, perhaps the company sold off a stake in a business that they wanted to get away from and they wanted to divest and focus on the core business. A lot of times they'll take the money that they earned from the sale of that company and pay it out as a special dividend. So the best example I can have of this is ADT. ADT recently they sold off their Canadian security business to a different company, and then they took the proceeds from that sale and they paid the dividend to shareholders. So why? But so stocks are very liquid. So liquid means they're easily sellable. So for example, real estate is very illiquid, meaning that sometimes if you want to sell your house, it may take months or years for you to be able to sell your house at the price you want it. But stocks are different. Once the stock market floor is open and it's in session, you can easily sell your stock. So in the United States, the stock market is open from 9:30 Eastern Standard Time, that's New York time, until 4 p.m. And then they also have pre-market and after-hours trading. So for example, if you guys trade on Robinhood or Fidelity or something like that, usually pre-market trading is from around maybe 7 o'clock or 9 o'clock in the morning until market open at 9:30, and then after hours trading would be from like 4 o'clock to 6 or 8. It really depends on your broker. Different brokers have different time periods. And these stocks can be quickly resold into the market. So let's say you buy Apple stock, for example, and the stock goes up a lot and you need some money. Maybe you want to buy a house. Maybe you want to put a down payment on something. Maybe you want to pay off some debt or something like that. You can easily sell those shares and take that money and do something else with it. So owning stocks is a common trait among the wealthiest Americans. So I read a study that says that the richest 1% of Americans own over 50% of the U.S. stocks. So what that means is that guys, owning stocks is a very big wealth building tool. It's very common. The richest guy in the world, Jeff Bezos, he owns a lot of shares of Amazon. So owning stocks is a way to kind of build wealth for yourself and for your family as well. And another good thing about stocks is stocks can be passed down to your kids and grandchildren. So obviously you want to leave a legacy for yourself when you pass on. And by buying stocks now, you'll be able to build wealth for your kids and your grandkids. So, when you pass on, you'll be able to pass down these assets and make your kids and your grandkids' lives much easier. Because if you buy stocks now, when your kids grow up to become adults and when your grandchildren grow up, hopefully if you're buying quality, these companies are going to be worth a lot more in the long run. And it's just going to make your heirs just going to make their life so much easier if they have access to high quality assets. And then the last reason why I think stocks are so important is that dividend stocks provide passive income for early retirement, guys. So dividend stocks, like I mentioned, as a shareholder, you can get access to special dividends. There are a lot of companies that actually pay a dividend either every quarter, twice a year. Sometimes they pay monthly dividends, or sometimes it's an annual dividend. And what happens is that as a shareholder, you get access to these dividends. So for example, Apple, they pay a dividend every 3 months. And what a lot of people like to do now, the new craze amongst millennials, is they build up a dividend stock portfolio. And then once their passive dividend income exceeds their expenses, they can retire early. Okay, so sticking with the same example I'm going to use throughout this video, Apple stock. As you can see here, this is what you'll see if you type in the ticker symbol into Google. So I typed in the ticker symbol AAPL, and this is kind of the information you'll see. So I'm going to explain what all of this information means step by step. So as you can see here, this is the exchange that is trading on, the NASDAQ. It's an American exchange. This is the ticker symbol. This is the latest price. So this is the price, as you can see, once the market closed, and then after hours the price went down as well. So I mentioned earlier you have pre-market trading and after hours trading. So let's talk about some of these stats here. So here is the open. So the open is like the opening price of the stock. So that's how much the stock traded for at 9:30, right when 9:30 Eastern Standard Time, which is New York time, right in the morning. Now we have the high. The high is the highest daily price. So that is like the top most expensive price that the stock traded at in that day. And then we have the low, which is the lowest traded price. Okay. So now we have also the market cap. So as you can see here, the market cap of Apple as I'm recording this video is $1.47 trillion. So that is the total value of the company. You calculate the total value of the company by multiplying the number of shares outstanding times the share price. And Apple is absolutely one of the most valuable companies in the entire world and one of the most valuable companies in the US stock market. So then down here you'll see a PE ratio. So the PE ratio is the price of the stock divided by the annual earnings per share. So as you can see here, Apple stock price is about $338 and the PE ratio is 26. So you just take the latest price over the earnings per share annual, and that's how you get the PE ratio. So usually people like to see PE ratios between, like, I would say 15 to 20. Usually if a PE ratio is over 20, the stock is considered a little bit expensive. So according to this PE ratio, Apple would be considered a little pricey, on the pricey side, a little bit expensive. So now we have the dividend yield. So the dividend yield is the annual dividend divided by the stock price times 100. So that is justified as a percentage. So basically what this tells us is that how much of the dividend is a percentage of the stock price. So as you can see here, Apple has one of the lower dividends. It's just under 1%. And the reason for this is that because Apple is still a large cap growth stock, usually large cap growth stocks as the stock price goes higher and higher, usually the yield will come down. And as the stock gets cheaper, usually the yield will go up. And then we have the previous close. That's how much the stock closed yesterday. And then we have the 52-week high. That is the highest price. Okay, so the 52-week high, that's the highest price that the stock traded at over the last year. So the last 52 weeks, which is the last year. And then the 52-week low is the lowest price the stock traded. So usually people like to use the 52-week high and the 52-week low as a kind of a quick gauge of how expensive a stock is. So if a stock is near its 52-week high, people tend to say that the stock is kind of trading at a more expensive level. And if the stock is trading near its 52-week low, it's much cheaper. Okay, so why do stocks go up or down? Well, there's many reasons why stocks move up or down. So the first most basic reason is earnings beats or earnings misses. So every 3 months, a company will release its earnings report, and that's what they have to do if they're listed on the New York Stock Exchange or the NASDAQ or any major exchange. And the reason they have to do that is because investors want to see what the companies are doing. It doesn't really make much sense if these companies are going to have people, investing their hard-earned money and they're not being transparent on what's going on behind the scenes. So if a company beats its earnings, meaning that it exceeds the earnings estimates by Wall Street analysts, then usually a stock will run up. If a company misses its earnings, that means the earnings per share is much lower than analysts expect. Usually they'll make a stock go down. So the second reason is new product launches. So Apple is famous for this, Tesla, and many of these popular companies you see, whenever they come out with a new product, usually that will send the stock up because investors are excited and they know that this will bring in new revenue and make the company more valuable. New contracts or partnerships. A lot of times companies will release press releases saying that they're doing different deals, working with big companies and things like that. Maybe they won a new contract, or maybe they're doing something with the government. A lot of times the government awards contracts to companies, or they have a new partnership. So maybe they're partnering with Microsoft or Amazon or another big company. This will cause the stock to go up. So changes in the economic environment. So this is a huge one, and this is one of the reasons why we saw such a huge crash recently during the kind of all the lockdown procedures and what's been going on. With not a lot of economic activity going on, that caused a lot of stocks to plummet. So definitely, if we're having shutdowns and stuff like that, the stock market is going to be affected. So positive industry news. So this has to do with kind of things like maybe the government passed new legislation. So this is really important. For certain companies where things had been kind of illegal, and then perhaps the government opened it. So the best example of this would be a company like DraftKings, who's really dependent on legalization of sports betting. So as the U.S. government allows online gambling and sports betting in more states, that will be good for DraftKings and DraftKings shareholders, because as DraftKings can enter more states, they can make more money. So dividend increases. So another big one is dividend increases. So for example, if Apple increases their dividend, that will usually cause the stock to go up, because a lot of people buy Apple stock just for the dividend, because they're dividend growth investors, and that's a good thing. Share buybacks. So share buybacks is another reason why stocks go up. If the company, like for example, Apple is doing a big share buyback recently, so if they're buying back shares, that means that if you own one share, when they buy back shares, they're reducing the number of shares outstanding, which makes your one share a bigger portion of the company without doing anything else. So share buybacks are a very, very good sign. And the last is greed and fear. So we kind of saw this during the whole lockdown thing of the early 2020. People got really, really, really greedy in the first quarter of 2020, and stocks were trading at a huge high. And then when the world went on lockdown, everyone got scared and dumped their stocks. So that's kind of what's been going on there. So greed and fear, these are two emotions. When people get greedy, usually stocks run up, and when people get fearful, stocks go down. Okay, so how much money do you need to get started? Well, you can start investing in stocks with as little as $100, but I think $1,000 is a much better starting point if you have some money. So obviously you need to think about this in a long term. Obviously, the most important thing is to get started. If you have $100, you could definitely get started on something like Robinhood or even a brokerage like Fidelity. But $1,000 is a good starting point, and you can either put that in one stock, or you can split that up among a couple of different stocks. So important thing to remember is that you only want to invest money that you can afford to lose. So you don't want to invest money that you had to pay your rent, or to pay your mortgage, or to pay your light bill or your gas bill or something like that, because stocks are risky and they can move very quickly. So you could lose your shirt, and then you don't want to get in a tough financial situation where you were buying stocks and then you lost your money, and then now you can't pay your bills. So the earlier you get started, the better. So it is a drastic difference when you start investing, I would say, in your late teens and 20s, than if you start maybe in your 30s, 40s, and 50s. And the reason for that is compound interest. So if you get started as early as possible, probably the best time to get started is when you start making money. So if you get your first job while you're in high school, or when you graduate from high school, or if you get your first job when you're in college or whatever, the second you get your first paycheck, start buying stocks. And the reason is that you're still young, and you still have so much time for these companies to grow. I mean, just me personally, I'm in my early 30s, and just watching companies like when I was in high school, companies like Apple, Netflix, for example, Amazon, these companies have grown so much, and I really wish that I had invested more aggressively in these companies, knowing that as I was kind of graduating high school and moving into adulthood, that these companies become more and more valuable. So there's a lot of examples right now. There's a lot of companies that have IPO'd recently, and if you're in your teens or 20s, be aggressive. Invest money, stay in the markets, and over time you're going to be happy. So then invest on a monthly basis and make it a habit. So this is a big one. So a big mistake people do make is that they just invest once and then they stop. You can be successful doing that, but consistency and doing something over and over again, making it habitual, that's going to provide you much better returns on your investment. So the best thing I can say about this is that automate it, right? So just pick a certain amount of money you want to invest every month, whether it's 50 bucks, 500 bucks, 1,000 bucks, whatever you can afford, and just invest that every month on a consistent basis. So obviously you want to invest as much money as possible, but you don't want to invest too much where you're not, able to pay your bills and enjoy yourself and things like that. So figure out a month amount that you want to invest and stick to it. And then the last thing I'll say is think long term and continue growing your portfolio. So, investing is a marathon, not a sprint. If you're looking to get something quick, you need to think about lottery tickets or something like that because the stock market is a reflection of the country's GDP. So, for example, the American stock market is a reflection of the American GDP. So, the fact that it takes time for the GDP to grow, it's going to take time for your portfolio to grow. So, think long term, think 5, 10, 20 years down the road. Keep growing your portfolio, keep watering it by adding money, and you will get good results. Okay, so I'm going to go over the stock market order types because this is a very important concept to learn as a beginner because as you get more experience and as you start to trade with bigger amounts, this is going to be very, very important. If you don't understand these order types, you could accidentally blow up your trading account and then, it's either you have to refill it with more money or you're out of the game. So market order, that's when you buy the stock at the current market price. So if Apple stock is trading at $330 and you set a market order, you're going to buy Apple stock or sell it at $330. A limit order is a very powerful tool. So what it does is it says, okay, instead of buying Apple stock at whatever the current price is, I'm not going to pay more than, let's say, $325. So this allows you to buy stock at cheaper prices because remember, we went over the stock market, the high of the day and the low. So stocks stocks will ebb and flow throughout the day until they hit their closing price. So this allows you to kind of buy the stock when it hits like the cheaper price during the day, or if you set like a good till cancel trade, it'll only execute the stock when it hits that low price. So when you're first starting out, you only put like, let's say you put $500 in your account and you buy one share of Apple. It won't make a big difference if you buy it at 330 or 335. But as you start to invest more and more money over time, it's going to make a huge difference because let's say you're dealing with a $25,000, $50,000, $100,000 trading account. Using limit orders can allow you to buy a stock much cheaper, which can save you hundreds of thousands of dollars in unrealized losses. So a stop loss order, this is a very, very important tool that I don't see a lot of people using. So what this is that you sell the stock, you sell whenever the stock hits your stop price. So let's say you buy Apple stock at 330 and if it goes down to like 320, you want to sell it. Well, you use a stop loss order. So if that Apple stock hits $320, it'll automatically sell it. So this is huge because it protects you from losing a ton of money. A lot of people, they buy a stock and it's down 20%. 50%, 75%, and they're still holding on to it. No, you want to use stop loss orders. For me personally, I like to get out of a trade if I'm basically down 10 or 20%. I know that I can usually buy the stock cheaper, or if it just goes against me, I cut my losses. You're not going to win every single trade. You're not going to make money on every single investment. There are times you're going to buy stocks and you're going to be wrong. Even Warren Buffett makes mistakes. Warren Buffett dumped his airline stocks, and a lot of airline stocks rallied back. So, everybody makes mistakes, and no one's going to make money on 100% of their investments. That's just part of the game. It's like Michael Jordan. Michael Jordan, he's the greatest basketball player of all time, and his career field goal percentage was 49%. So that means Michael Jordan, missed 51% of his shots. And I think his three-point field goal percentage was like 32%. So he missed 68% of his shots. So you're not going to hit on every investment. You'll just accept that as a fact and use stop loss orders to limit losses. So a stop limit order is when your order hits your stop price and turns into a limit order. So let's say you want to sell Apple stock at 320. Well, what you can do is you can simply put a stop limit order. So you can put your stop order at like 320 and then it'll turn into a limit order. So maybe you want to sell it for no cheaper than like 322. So what this will do is it'll kind of just give you more flexibility, but I usually just recommend using stop loss orders much easier. And then Finally, we have a trailing stop loss order. So your order changes based on the stock price. So a lot of people, they like to use trailing stops. They might set it at 10%. So if the position comes down 10%, it'll sell it automatically. But this also allows you to lock in gains, because let's say the stock runs up 50% and then it pulls back. Well, then your order will be executed. So a trailing stop loss is another really powerful tool as well. So trailing stop loss orders and stop loss orders, probably the two most powerful things to protect against huge losses. Okay, so here we are as an example. This is an example on Fidelity. So how to place a stock market trade? Well, it's very simple. So first you're going to have to open a brokerage or stock trading account. So I'm going to list, I don't want to talk about these right now because I just want to focus on how to place a trade, but I posted a list of the recommended stock brokerage, stock trading apps in this video. But off the top of my head, I'll tell you guys what I use personally. I use Fidelity for my retirement. I use Robinhood for options trading, and I use Webull for like speculative penny stocks. So those are the three apps that I use the most, and then I have an emergency fund with an app called Stash. And I'll link to all of these brokerages and all of these stock trading apps in the description below, so you guys can check these out later. But basically, you just want to open a brokerage or stock trading account. So it's as simple as going to these sites. You enter in your information, you open an account. Very simple to do. Usually it takes 5 to 10 minutes, no more time than that. Second thing is you want to deposit funds. So you obviously need money to trade. So you want to put, you can start off with $100. That's all you can afford. I would say at least try to put at least $1,000 in there. But for some of you guys, I know you have a lot of money saved up. So, you don't want to invest with money you can't lose. But if you have some money saved up, put $5,000, $10,000, $20,000, in there. The more you put in there initially, the easier it's going to be to grow your money over the long run. So now you want to enter the ticker symbol. So as you can see here for this example, I entered the ticker symbol Netflix NFLX. And as you can see here, we have the stock price $418. Very simple. So you enter the ticker symbol in here. It's going to pull up the latest price and things like that. And then all you have to do is choose your order type. So for this example, I've chose a market order, so it'll just execute the trade. And then I'm going to purchase one share. And then time in force. So on most brokerages, they're going to have either a day trade or a good till canceled. So for this example, I just push a day trade, and then I want to place the trade. I would just simply click preview order, and then on the next page, it's going to ask me a bunch of questions. Is this, do you confirm this trade? Stuff like that, blah, blah, blah. And then I'm going to say yes, and it'll execute the trade. So it's very easy to do. And this is just for Fidelity, but most brokerages use the same simple process. So if you understand it for this, you basically very simple to place a trade. Okay, so let's give you guys some general tips that I've kind of learned over the years. I've been investing ever since I was in high school, so I've learned a lot of things. I've made a lot of mistakes along the way, so give you guys some more tips. So the number one tip I would say is invest in companies that you understand, and this was probably the mistake I made when I was much younger. I was buying things like oil stocks and drilling companies, and I don't know how these companies make money. I mean, obviously, they drill and do things like that, but it's just out of my circle of competence. Me, I understand tech, I understand finance, things like that, and I understand companies that I use. For example, I own Netflix stock. I use Netflix all the time, so I understand how they make money. So it's really important to invest in companies you understand. So the easiest way to do that is just look around your house. Look at the type of products that you buy personally. What do you use Netflix? Or you want to use an iPhone? Keep things simple. Do you wear Nike shoes? Do you shop at Walmart? Keep it simple. Figure out, look around in your own life, the products that you use or your parents use or your friends use, and start from there. It's much easier to invest in something that you understand than some complex company that you just don't really even understand it. And when you try to read the earnings reports, it just seems like gibberish to you. So just keep things simple. The second tip would be don't buy all at once. Build a position slowly. So another tip is that if you want to buy, for example, you want to buy like Apple stock, don't just dump all your money at once because maybe the price might drop. So what you want to do is you want to perhaps maybe build your position over time. So instead of maybe buy like 100 shares, buy 25 shares. And then kind of slowly build up the position so that way you're going to get a better average price. You don't want to just buy Apple stock and then it drops 10% and then you're like, well, I've lost 10% of my money. Should I sell? Or It just creates a lot of problems. So just buy it slowly over time. The next tip is use stop loss orders to minimize losses. Guys, this is so huge. You really need to use stop loss orders. They're just so important. So whenever you buy a stock, you want to have in your mind, what price would that this stock comes down to, I'm done with this trade. And remember, I gave you guys the example about Michael Jordan. He only hit 49% of his field goals over his career. So some investors or traders, maybe they have 50% of their the stocks they buy go up, sometimes 70%, 80%. But just realize that there are going to be some investments where you buy and you're like, whoa, I made a mistake here. So use stop loss orders to minimize losses. So you're not holding this stock, it's down like 70% and you're freaking out. That's what stop loss orders are for. And for me, usually if I'm down 10 or 20%, I'm out the stock. I chalk it up as a loss, I move on. So earnings drive stocks in the long term, guys. So this is another important concept to understand, that over the long run, the company's earnings are going to be driving the stock price up. So the best example of this is Tesla. Tesla's had a lot of good earnings reports, basically in 2020 and in the second half of 2029. So that stock has ran up a ton. So pay attention to earnings. Amidst all the news going on and the hype, earnings drive stocks. So also pay attention to revenue, earnings per share, and retained earnings. So these are probably the three most important metrics out there. Revenue. If a company is not making revenue, they can't have earnings. So you want to look for companies that have rising revenue. Earnings per share. You want to look for companies that are doing earnings. If the company's in a growth stage, they might not have positive earnings. But for companies that are kind of more mature and older, you want to see positive earnings. And retained earnings, guys, this is very important. So you can find this on a company's balance sheet. Sometimes it's labeled retained earnings, sometimes it's labeled accumulated earnings, but this will tell you how much earnings the company has accumulated over the entire period of the company. So what we don't want to see is, we don't want to see like negative 20 billion or negative 50 billion. We want to see that number positive, because that means that the company has been profitable over time. So another tip I'll give you guys is read quarterly and annual reports to gain valuable insight. Everyone uses Yahoo Finance. Everyone uses the basic statistics and stuff like that. If you take the time to read these quarterly and annual reports, it's going to help you remember why you bought the company in the first place, and it's going to kind of alleviate your fear of losing money. So the best example of this is for instance, Netflix. While everybody's hating on Netflix and saying that the stock is too expensive, that there's too much competition from Disney and things like that, I always read those quarterly reports and I continuously see those subscriber numbers going up. I continuously seeing that revenue going up. It puts me at ease and makes me realize that, hey, no matter what other people are saying, the numbers don't lie. This is a good investment. And the last tip I'm going to give you is cut your losers and ride your winners. I see so many people, they make a little bit of money on the stock and then they sell it, and then they're still holding on to losing positions. You don't want to do that. If a stock is not going the right direction for you, it's no guarantee it's going to return back. It's best idea to cut your losers and ride your winners. If you bought a stock and it's going up, it keeps going up, obviously you want to take some profits, but don't be afraid to buy more of that stock. The best example is Tesla in 2012 was trading at around, I would say, 2010, 2012, it was trading, it IPO'd at $17, and as of recording this video, it's at $900. So the people that bought Tesla stock at around 17 or 18 bucks, they continuously added to that position. Now that stock is worth a lot more. So if you buy a stock and it keeps going up, don't be afraid to buy more of it and just double down on your bet, because if you pick something good, why get rid of it? Hold on to it, because a lot of times these stocks can grow so much more in the future. Probably another good example is Netflix. Netflix was the best performing stock from 2010 to 2019. So cut your losers, ride your winners. Okay, now so I'm going to talk about some recommended stock brokers and apps. So I'm going to link to all of these in the description below, guys. But I'm just go through these really quickly. So Robinhood is probably one of the most popular ones out there, and it's a great one if you're just a beginner getting started. You can buy stocks for free on there. You can buy cryptocurrencies, trade options for free. Everything's basically free. They even have dividend reinvestment plans where if you get a dividend, you can reinvest it automatically. They have fractional shares. You can buy fractional shares. So, for example, if you want to buy a share of Apple, like $330, but you only have $10, you can just put $10 into Apple stock. So I think Robinhood's a good choice. There are some drawbacks, things like that, like you can't have a beneficiary, but I think overall it's a very good choice. So I use it as well. So Webull's another emerging one that's pretty popular. I like to use that for trading penny stocks. They have a lot of nice things there. You can do paper trading, which allows you to trade with a practice account. So that's a really good app. I think if you're a beginner, you can paper trade for a while, and then you can get started with real money. They allow you to buy stocks and things like that. So another reason why I like Fidelity is I use Fidelity for my retirement, and Fidelity is a lot more flexible than Robinhood or Webull. So this is a full service brokerage, meaning that you can do many other things. You can buy mutual funds, index funds. You can set up trust and gift accounts for your kids, retirement accounts, SEP IRAs, Roth IRAs, so many more choices. So I use Fidelity for my retirement account, and that's kind of my very super long-term account. And then Stash is my emergency fund. So I like Stash. It's like a banking and checking app. It's not really a traditional brokerage, but it's a really cool app, and it's very cheap. If you have under $5,000 in there, they only charge you like $1 a month or something like that. And if you have over $5,000, I think the fees are like $12 a month on like a $5,000 account. Very small percentage, maybe like a quarter of a percent. So very cheap. Anyway, the fees are very cheap on Stash, so that's another good recommendation. So some other brokerages that I've heard good things about: TD Ameritrade, that's one based in Canada. That's a good choice. Interactive Brokers, that's probably the best international brokerage if you guys are living outside the North America. If you guys are living in Asia, perhaps Europe, Africa, something like that. Latin America, Interactive Brokers is a good choice. So now another one that I've heard good things about is Revolt. So that's a good one for European citizens. They're based out of the UK, and I think Revolt is getting really, really popular in Europe. So that's a good choice if you're in Europe. Okay, guys, so I'm going to go over the recommended stock investing tools. These are the tools that I use personally every day when I'm researching stocks to invest in. So the one I use the most is probably Yahoo Finance. They show up number one in Google whenever I type a ticker symbol in, and they have lots of good information on there. They've got statistics, financial information, information about insiders, trading, institutional ownership. Conversations is very interesting where people like to talk about the company as well. The quick statistics, they talk about dividend yields, profit margins, things like that. You'll find a lot of good information on Yahoo Finance. The second one I like to use is Bar Chart. So Bar Chart is another site which has a lot of good information on volume, information on stocks that have been going up recently, stocks that are trading at 52-week highs. Lots of different information. You'll see it on the left side of the chart. It's very interesting. The third tool I use is TradingView. So this is actually the stock charting software that I use for most of my videos. I like it because it's very easy to use and very easy to draw with. And you can find that one, tradingview.com. So then robintrack.net. This is another tool that I like to use to kind of find the most popular stocks on Robinhood. So it kind of shows me exactly which stocks people are buying and selling. It also shows me the stocks that are the most widely owned. And then Wall Street Journal. So if you guys are looking for a good newspaper to subscribe to, subscribe to Wall Street Journal. It covers the stock market in crazy depth, and it provides a lot of insight, and you'll find out a lot of interesting news stories on there before they become popular and things like that. Twitter. So I like to use Twitter. A lot of good, very brilliant stock investors are on Twitter, and they do provide information about some very good stocks to buy. And it's just a great way to kind of keep in track with the market. For me, it's been like the probably one of the most useful social networking sites. And finally, Reddit. So I don't really contribute to Reddit much, but I kind of lurk on that site, and I found a lot of useful information on Reddit. There's a lot of people on Reddit. They have a few subreddits like Wall Street bets, stocks, investing, things like that. And you can find a lot of good information on there on some stocks to buy. Okay, so thanks for watching, guys. That's about it. It's about time to wrap things up. Please subscribe to my channel for more stock market investing videos. If you guys have any questions, you can leave them in the comments section below. So you guys, you can also, if you guys need to contact me personally or something like that, this is my email address. You can reach me at, and you can also find me on Twitter and Instagram as well. So guys, that's it for this video. I hope you enjoyed it. I didn't want to put too much advanced information out there. I wanted to guys just give you what you'll need to get started as a beginner. So the most important thing is you don't want to deal with information overload. Keep things simple and get started. And it's just like any skill, you're going to learn more and more over time. But the most important thing is to take that first step. So I hope you enjoyed this video, guys. Until next time, take care.